Hey everybody. Lately I've been getting asked a lot of questions about what I think is going to happen to interest rates and what I think is going to happen to home prices in 2023. So I put together this presentation to kind of help share those opinions and also show you why I think they're going to happen. So we've seen home prices come down lately following the record highs for the past few years. So what does 2023 have in store? Rates started slowly rising throughout all of 2022. Going into the fall and winter, we saw demand decrease as rates got higher. As always, supply and demand will play a big role in 2023, and interest rates will heavily impact the demand as we saw this past year. We're starting to see signs of improvement, and we think it'll continue through 2023. Now let's jump into why that might be. Inflation drives mortgage rates. Historically, mortgage rates take a lead from inflation. The colored line at the bottom is the inflation. The white line above are mortgage rates. We normally see that when inflation rises, rates rise, and as inflation softens, rates drop. The black bracket is a strange time. That is the Fed's quantitative easing period, or when they were buying mortgage bonds in order to stimulate economic activity. We start to see inflation spike right here, yet the Fed continues to buy mortgage rates, and mortgage rates remained steady. During this period, the Fed says that inflation was going to be transitory. With the increased purchasing power, everybody consumed and spending went up. This was clear the past few years with home prices going well over asking price and home values skyrocketing. In 2021, though inflation spiked, mortgage rates were steady due to the Fed stimulating the economy in that QE period. Now, inflation wasn't transitory, so the Fed stopped buying mortgage bonds, causing interest rates to do what they normally do, which is follow the inflation. That trend has continued, and as inflation's improved as expected, rates have started to follow. So here you can see the inflation coming down and mortgage rates following the inflation. Now, when will inflation peak? This chart right here shows the Core Consumer Price Index, or the CPI, and it's currently at 5.7. Now, how they get this 5.7 is they add up all of these monthly year-over-year numbers. So this right here is the year-over-year number from 2021 to December 2022. Now what's interesting is if you add all these up right here for the last 12 months, that equals the 5.7 number. Now how it works is when the December number comes out, the December number in 2021 falls off. And so looking forward, what we see is we see this higher 0.6% falling off, this higher 0.6% falling off. We got 0.5, and then we skip to April, and we got another 3 months in April, May, and June of higher CPI numbers falling off. We expect these to be replaced by these lower CPI numbers closer to 0.3 and 0.2. So as inflation comes down, we expect interest rates to come down, and we expect inflation to come down just because we can see where the interest rates or where the inflation readings are coming in currently, and we can see what's about to fall off. Now, shelter costs is a major component of the CPI number. Shelter accounts to 39% of the CPI. Now, this purple line right here is the current year-over-year change in apartment list, and that has been coming down. And so this is the current reading right here, and you can see where we peaked, and now the current apartment rents have been coming down. Now the CPI, how it calculates shelter, is it actually takes a 12-month average. So the CPI number that includes shelter is still going up. Shelter is still increasing in that CPI number, and that is not good for the CPI, but that's just because of the math equation and how it's calculated. We know that the current shelter costs are actually going down, but the CPI number is still going up. It's kind of like a roller coaster. The real shelter costs are on its way down, but the CPI takes a 12-month average. So the number that's reported to the CPI number is still going up and still going up and still going up. So we got a few more months for that CPI or that shelter cost to go up, and then we expect the shelter cost in the CPI number to go down. So we're expecting the CPI number to come down naturally just because of the current readings are much lower than the readings that are falling off a year from now, as well as we expect the shelter cost to increase a little bit and then really start coming down further, even more aggressively, dropping that CPI number. Inflation number comes down, we expect rates to follow. So all segments of that CPI number are lower except for shelter. Prices have been coming down across the board for food, gas, clothing, and all of these are reflected in the CPI. But the shelter costs, which remember are 39%, although getting better, because of how it's calculated, there's a lag effect. Now, I wanted to show you something else that's really interesting. This is a 35-year history of the spread between 30-year mortgage rates and the 10-year Treasury. And historically, that spread is around 200 basis points or 2%, meaning if the 10-year Treasury's at 4%, then mortgage rates should be at 2% higher or 6%. But what's happened during the last 6 months is that spread has widened. That spread is now 300 basis points today. And this is because with the interest rates going higher, the servicers, which collect your payment and send the payment on to the bondholders, they get paid a fee for servicing that loan. And they don't want to service loans with the higher interest rates. And so they are not paying the same value for the servicing. But we do expect that as the inflation number comes down and interest rates come down, that servicing value will come back, and that will change that normal spread back to around 175 to 200 basis points, or back down to say 2%. So we expect interest rates to come down simply because of the CPI number, but then as that spread goes from 3% to 2%, that should cause interest rates to come down an additional 1%. Now, there is a recession coming. So why isn't the official word out on the street? Because to declare a recession, the National Bureau of Economic Research has to do it. And they typically don't do it until we've been in the recession for a year. So by the time you officially hear about it, you're pretty much already out of it. Similar to that roller coaster visual earlier, we're already on the downward trend before the tail hits that peak and it's officially been observed and reported. I agree. It's super helpful for them not to tell us, but we can already see the signs. First, we got credit card debt. Here's what credit card was doing. And then we had COVID with the stimulus, and you can see people took those stimulus checks and they paid off all their credit card. But since COVID, this is what credit card's been doing, and it's now substantially higher than we were before COVID. And the same thing happened with personal savings. Prior to COVID, we had personal savings around here. They did that giant stimulus, and the personal savings rates came all the way up to here. We slowly started spending that money, and we got a second round of stimulus and a third round of stimulus. But with the stimulus gone, the personal savings rate has dropped significantly lower than when we started prior to COVID. Another sure tell indicator of recession is an inverted yield curve. And this is the difference between the 10-year Treasury and the 3-month Treasury. Now, typically, the longer-term 10-year Treasury should pay a much higher interest rate than the 3-month. But today, you can get a higher interest rate on the 3-month Treasury, the short term, versus going to a longer term with the 10-year Treasury. And you can see that since 1980, every time that we've dipped negative, a recession follows. Negative, recession, negative recession, and right now, we're really negative. Now, recession sounds scary, but really, it just means people will be more thoughtful and careful, which isn't so bad. We also know that the recession means that rates go down to restore purchasing power and stimulate economic activity. Okay, enough recession. Let's talk housing. As with other segments, supply and demand is one of the most important aspects to housing. So let's look at housing demand. For the better part of last year, we were forming new households above 1.75 million a year. Now, what is a new household? A new household is when someone breaks off of a current household and forms a new household. This happens when people get married, when they move out of their parents' house, or in the case of divorce, where they now need two houses. With rates rising through 2022, we saw new household formation plummet down to around 1.3%. Now, this doesn't mean that households weren't forming and that events didn't happen. People still got married. They still got divorced. They outgrew their childhood homes. But they decided to hold off on forming a new household because of the current interest rates and house prices. It might seem that we have a lot less new households being formed right now, but that's not true. They're still there. They're just sitting dormant, compounding, patiently waiting for interest rates to come down. Now, on the supply side, things have actually softened a bit. Builders have slowed development. They're currently completing about 1.5 million new units a year. But you got to remember that we have to replace about 100,000 homes every year, and that nets the new supply of around 1.4 million units per year. Currently, with 1.3 million household formations, we have an extra 100,000 homes in inventory. This is why we're seeing homes sit on the market longer, sell for a little bit less, sellers make price improvements, or give concessions. As rates come down, we'll see those dormant household formations climb back towards that 1.75 million a year rate. The current supply of 1.3 will not be enough to support demand. I believe this will drive prices and competition up again. Now, builders, for the most part, have learned their lesson in the 2006-2009 crash, and they've slowed down to avoid oversupplying, and it might take a minute for them to ramp back up. So, our housing forecast. We see lower inflation. We see a recession-like slowdown. Incomes are increasingly going up. Even though home prices are going higher, with incomes going up, it helps affordability. And we still see a very tight inventory environment, and rents still expensive to rent, and rents are slowly going up. We see low single-digit appreciation for most of Utah, with a pickup in activity or more transactions happening. Our mortgage rate forecast, we've got some headwinds. We have global quantitative tightening, we have a lack of central bank buying, and there are more debt to be financed with the packages that they've been putting together for Ukraine and whatnot. Our tailwinds, lower inflation is coming. There is excess homes on the market. We expect an increase in mortgage servicing value, and the recession is likely, and we know that during recessions, interest rates decline. So we see the 30-year fixed rates move near 5% sometime around the first half of 2023, and we see the U.S. 10-year Treasury dropping down to 3% or lower. So I think there's good news ahead. I think there's reasons to be optimistic for 2023. I wish you all the best. I wish you health, happiness, and prosperity in the year ahead. Thank you.